Okay, following on from the Flux News show, we were talking about the fuel oil cracks. We're going to revisit this because we did a video on this a while back as a trade idea. Harry and Tom are with me from Onyx Markets. So let's just dive into it, right? We said short the deck crack a while back. It was 750 around there.
Yeah, it was about
minus
750.
Yeah. Didn't do too well. It's now minus 650, but again, it's all in the risk management of it. We think the factors at play in summary are building up again, right? We've got very high prices for a while that kind of leads to refiners to start gearing up a huge amount of production in that market to profit from these high prices. That kind of leads to a surplus in the long term. We've got more heavier crudes coming on in the market from the Middle East, and utilization's going up with refiners, which generally means they have been running as fast as they can or as high as they can in their rates, which leads to production of more waste products. And fuel oil is a waste product. It's what you produce off the back of producing all these high value products. So that's the general summary. We still believe in this. We believe it's due a decent turn after being strong so much, and this could be like a pretty serious collapse, basically, right?
Yeah, exactly. And I think even when we suggested it in the first place, we tried to set the stop as an acknowledgement that
it's contrarian.
It's pretty contrarian, and we're still we're to a point trying to catch a turn, but we're trying to sort of anticipate that like more deferred selling, which you are kind of seeing now on a price action basis. But yeah, I just don't think we were expecting this strength to sustain for so long.
But you'd still be in the trade if you've had a wide enough stop, or you could have stopped yourself out very quickly and just waited and keep small bits trying to catch this turn. And as you get the turn, that's when you're starting to scale in, because this is a long-term trade. We're thinking, now it's what, minus 650?
650, yeah.
So $1 higher, but this is on the large scale of things. We're expecting like a $5, $6, maybe even $7 rally sell-off here.
Yeah, we were looking at, I think what we spoke about is sort of selling off into the mid-teens. So, $1.50 stop on that is really not a lot, especially if you think you're going to have to ride out some volatility. You're not in the market conditions you're expecting yet, but you think it's a nice point to enter.
Okay, so is there anything, let's get out the graph, and is there anything else we can say?
Yeah, so on the screen now, got the graph. This is the deck barge crack again.
So you can see, just like eyeballing the chart, the volatility has decreased quite significantly. It's in this like really, really tight range. And, the thing what you're not seeing, you'd have to compare, and you get Flux for free. You get all these charts free if you've got the Onyx Markets account. You'll be seeing the prompt. So right now, that's July crack. That's wanging around like mad. But this deck is a lot more stable because it's the way the forward curve works, right? As the prompt contracts, the July contract moves violently up and down, so do the time spreads, which links you to deck. So deck can kind of stay stable for a while. So we have been seeing in the market a lot of Q4 selling, so a lot of people selling Oct, Nov, and Deck contracts in this market. Probably one, speculative reasons, two, probably hedging their length in the front, and again, another reason why we think could be due a turn. But yeah, from a technical basis, it doesn't scream sell. I think it's still a contrarian trade. So I guess, Tom, we could go back over that risk management if you are selling on a contrarian basis, right?
Yeah. So I think it's a little bit like what we were proposing to do on that gas oil trade a few weeks ago, where we said, we're very unlikely to be able to catch the top first time round. So maybe we want to, set ourselves up to have a few goes at it, rather than kind of risking everything on a single trade, maybe break it down into 3 or 4 clips.
Tight stops.
And then, when the first stop goes, sort of wait for the market to kind of top out a little bit, and then have another go, and just give yourself a few chances at it.
Yeah, so this is all about being in the trade when it does start to move aggressively. So looking at the chart again, if we say we're at minus 650, if we start really kind of going down through the recent lows, so you could say as we start seeing some aggressive red lines going down, hitting through 750, even minus 8, you've got that really long-term average below at, what is it, minus 9, is it?
Around this purple line, minus 850-ish.
Yeah, so that's a great point to be like, look, you're
the 100-day moving average, that is.
Yeah, the 100-day moving average, you're in this like long-term trend. You've still got 5 months of trading basically, but 5 to 6 months you would keep this contract live. That's a long time for the market to really kind of follow through. And look, this is a classic example of where a great trade would actually be an option, a put option. And we will be working to bring this to the Onyx Market audience very soon. But just for now, there is another way of looking at it, Tom, right? So you've got this, if you've got a volatile market and you're trying to catch the top, splitting up your risk capital and having a few goes at it and stopping out quickly, having a few goes at it, and then once you do it, scale in. You could also say, look, if you just want to park this, you could just have a very, again, you split your risk capital. Let's say you want to risk $1,000 or whatever it is, and the minimums are a lot lower than that. You can have like $100 on, right? You just have a very wide stop for a small amount of capital. So you could put your stop like -$4, which would be like very wide, right? It's barely got there in the more near-term contracts, and you would be severely wrong if it got to -4. Like this just isn't happening if it got to -4. So you could just keep that stop in place. And what you're doing is you're waiting for it to play out and then start to trend. And then when it starts to trend, that's when you scale in. So what that does is just allow you to be in the trade. You're not going to lose a lot, but you're not going to make a lot either. Or the other way around, you're not going to make a lot, you're not going to lose a lot either. And there's something to be said, isn't there, Harry, from speaking as a trader. Being in a trade is so different to waiting on the sidelines.
Yeah.
Because you're always waiting for that perfect moment. If you're in a long-term trade, it gives you more confidence to be scaling in as things start happening. And
you take more of a vested interest in it, and
you're watching it all day.
You take the risk management more seriously as well. And at the end of the day, like when if you're a trader, that's kind of what you need to be putting yourself in harm's way to some extent. So having skin in the game is essential. Yeah,
it's almost like an investment. So you could see it in this perspective. So again, the chart, we could say, if you're entering right now, if you've got, $1,000, we want to be, let's just say a $2 stop would probably be ample, I would say at this point.
Yes. So that'd be around $4.50 a barrel.
Yeah, so $4.50 a barrel would be your stop, and the position sizing,
it would be sort of 500 barrels then, wouldn't it?
500 barrels, and assuming you want to risk the 1,000 up front. But if you want to go, let's say you only want to risk 1,000 for the whole trade, then split that by 4, let's say, and that will get you to 125 barrels. And then what you want to be doing is, I would say that 100-day moving average is quite a nice line to be saying. Once it starts to head towards that line or even break through that line, that's when you're putting in the full investment of the trade. So you can use the money made up to that point, which is $2 again. So $2, you would have made your, well, depending on what you've done, but let's say you've done the 125 barrels, you would have made $250. Then you can use that $250 plus the initial $250 you were the $1,000 you were intending to risk on the whole trade. And all of a sudden you can use all that to like leverage up and sell the full balance, which would be what on a volume basis at that point.
I suppose it would still depend on what your stop was then. But assuming that your stop was maybe your entry level, then you'd work up to what, like 550 barrels or something, 600 barrels.
Yeah. So there you go. So either way, the point is that you want to be reinvesting that $1,000 that you always intended to risk plus the 500 you've made or whatever it is, and work out from there. Yeah, as you say, bringing the stop to 650, having a $2 stop, somewhere in the region of at least double your size. And then you can really participate in that move downwards longer term. And again, it's a time thing as well. If you just let that breathe as that starts to trend lower, you just, the more you leave it, if that makes sense, have that one proper entry after being in the trade and then one scale in, you can let this breathe and you don't have to keep chasing it down. And if there is a big enough downside to this, which we think there is on a risk reward basis, you're essentially looking at, risking roughly $2 to make possibly 7. So the risk reward there, and then with that one scaling, is getting towards like 5 times. So it's a really good long-term trade if you believe in what we're saying. On the flip side, if you want it to be long, what would you say the best trade is here? I guess it's a longer term. It's the opposite of contrarian, right? You're kind of ish trending higher.
It's a very slight trend, but you'd sort of be, I guess, looking to enter maybe around that sort of 30-day moving average if prices, well, I mean, again, that's kind of finessing it a little bit too much, but
I say if you're buying, because the volatility's been lower, you want to be keeping your stop kind of relatively tight on the historic on the lows, because on the flip side, if you know that's going to be breaking and starting a new trend lower and it's vulnerable to that, you want to make sure you're getting stopped out quick if that's the case. It looks like it's around 750 would be your stop. So you enter at 650, you stop 750. And I guess what your rationale for this trade would be, well, look, the more prompt contracts, the June and July, they've been rallying up, $3-4. So the volatility might be low, but as it gets more towards a prompt contract, the volatility starts picking up. There's more interest in it, and it can start to perform like up or down. So if you were bullish, it's actually quite a nice risk reward as well, in the sense of like, there's a lot to be said about what's called a roll-up trade. So every month, which has been happening on fuel, it goes higher, the prompt goes higher. So you basically buy the back end, wait for it to be prompt, and profit from it rolling up. It's just a matter of what your view is. I guess the difference in risk management is it's not a contrarian trade. So you have in this case, a reasonable stop wide enough to ride out the recent volatility. And it's kind of a one entry play, I would say. You're waiting for it to be prompt, get a few dollar rally and sell out. And you could be looking at a 1 to 3 risk reward ratio there as well. But again, our view is probably more towards the downside. And certainly it's stacked on a historical basis to be way more room on the downside. But I think that summarizes it best. Again, a reminder, to go and look at these charts, right? Even if you don't want to do this trade, there is a free Flux platform, the best data out there in the oil market. This data coming from our trading floor, which is the world's largest liquidity provider in the oil market. So really worth checking out. Thanks for listening, guys, and see you again soon.